Ladies and gentlemen, markets are officially broken. JOLTS job openings, the metric that tells us how many jobs are available in the economy, plummeted by about 500,000 jobs, worse than expected, which is insane. The expectation was 7.99 million job openings. Call it 8 million. That's a rough ballpark. We came in at 7.443 million. There was a time in which markets would have actually reacted to this, for better or for worse. Today, no. There was absolutely zero reaction to this. And this is basically telling you that there is less job openings out there, that the labor market is getting tighter and tighter, and it does mean the unemployment rate is likely going to rise further. If there's more people looking for jobs and there's less jobs available, that means unemployment rate goes up. The reason I say markets are broken, it's specifically the bond market that I'm referencing. 10-year treasury yields went higher today. At the time of recording this video, 10-year treasury yields are at 4.30%, up 2.5 basis points today. But we did just get a bond auction that came in good, that dropped the yields about 3 basis points. So you were really up over 5 basis points just 15 minutes ago or so. So let's break that down. What does this really mean for markets? The bond market is unhinged. Now, why is the bond market unhinged? Well, higher inflation expectations via the election. So there's some election risk getting priced into the bond market. On the other hand, you have what is irresponsible government spending currently, but it's really in anticipation of more irresponsible government spending and larger deficits. Now, the other reason why bond yields have been moving higher is the streak of good economic data that we have been getting. But wait, today's economic data was not good. It was not strong. It was not supposed to cause bond yields to move higher. Today should have been a day in which bond yields plummeted, judging off of the massive miss we had to JOLTS job openings. So the bond market is detached. It's not acting rationally with the logic that we have been accustomed to. So a lot of people were under the impression that the bond market was moving yields higher just because the economy has been strong. Today throws that out the window. The bond market looks to be reacting to higher inflation expectations that a new government is going to spend more money, going to deficit spend more, and drive the US economy into more debt. This is now a dangerous arena to be in because that is really subject to many different interpretations. We don't know, one, who is going to control the Senate, who's going to control the White House with any degree of certainty, and we don't know what the fiscal path forward will be. Is it going to be one that raises deficits, that causes, more government debt, or is it going to be a more conservative approach to government spending? We don't know. So between now and the election, bond markets are, at least for now, going to be unhinged. This is leading to an outperformance of big tech. Now, again, it's easy to love big tech before you have the earnings results. And that's kind of the situation that we are in now. Sure, we just had Google report earnings, but what about your other, big tech names? It's easier to buy these names in anticipation of a low bar and good earnings to come. It's not until after earnings season that you may see the leadership change in markets. Perhaps big tech continues to lead the markets, or perhaps maybe just okay big tech earnings could lead to a broadening out of our markets. That is still to be determined. Here on the day today, the Russell 2000 is taking it on the chin via the rise in 10-year treasury yields. The Russell 2000 did look worse at the start of the trading day. The Russell 2000 is currently down 0.57%. The NASDAQ, again, outperforming, up 0.74%. The S&P up 0.31%, and the Dow is red, negative 0.9%. I guess this is what you would expect to see if the economy does weaken. As per the data we got today is showing the labor market is weakening. You would expect to see big tech outperforming. But the question is, with big tech sitting at all-time highs, is it too much? And that's where earnings will help validate whether it is too much, whether expectations are too high for AI, or if, at least in the near term, or if these companies are going to outperform and continue to impress, in which in that scenario, these stocks will continue to move higher. Consumer confidence surged today as the election nears, while job openings move lower is the main headline on CNBC. The Conference Board's Consumer Confidence Index for October rose more than 11% to a rating of 138, its biggest single-month acceleration since March of 2021. You also had the U.S. trade deficit that widened more than expected today, and you did have inventories that drop. So U.S. retail inventories, excluding auto, the advanced number came in at 0.1%. The forecast was 0.5%, and the previous month was 0.5%. U.S. advanced goods trades balance came in at negative $108.2 billion. The forecast was negative $95.95 billion versus the previous month of $94.22 billion, and that's stimulative to the economy as well. It's the deficit. I mean, stocks love a higher deficit. And actually, most of the reason why stocks are near all-time highs right now, I would argue alongside Sven Hendrick, that it has to do with the deficit. It has to do with the government spending more money than they're actually bringing in, or in terms of the economy, spending more, buying more than they are actually bringing in, because we're running 6-7% deficits right now. That is what you would expect to see during a world war or during a recession, right? These are recessionary like stimulus measures, if you will, that are happening in which at a time, people think the economy is doing just fine. Now, today's data throws some cold water on that. We need to be a little bit more concerned about the economy following the massive plunge in JOLTS job openings, and the fact that that's not getting reflected in the markets makes me a little nervous, but we don't have enough info to really freak out about that just yet. And I don't think the markets will freak out until at least after big tech earnings, because the markets are going to give big tech the benefit of the doubt until we get more of these earnings. But again, back to my main point, something is broken in markets with 10-year treasury yields that moved higher, bond prices that moved lower following cratering economic data. That's not what you would expect to see. And it throws out the window the argument that bond yields have been moving higher on a strong economy. No, the economy is not as strong as we thought, and bond yields are still moving higher. That means, in simpler terms, again, we're probably moving higher in bond yields because of the election, because of the deficits and the fiscal path that is expected to continue to be irresponsible. Liz Young Thomas on X says September job openings came in 557,000 below expectations. Data points to very low labor market churn. JOLTS hires and quit rates are at cycle lows, while confidence boards labor differentials suggest a slow but steady labor market. A tick up in layoffs is concerning, but all in all, the data is fine. And Vanguard is out with a new warning, if you will, for U.S. equities that says, well, expect 3.2 to 5.2% return per year over the next 10 years, but that the U.S. economy and growth stocks could annualize about 1% growth over the next 10 years. That's a little on the low side. And I think this is a pretty good chart from Nick Timmerhouse that shows the job openings rate, which is, again, plummeting, the hiring rate that is starting to come up a little bit, the job quitting rate that is also plummeting, so people are not quitting their jobs nearly as much as they were before, and the layoffs rate that is starting to rise. And here's another great chart of the JOLTS layoffs that rose to 1.833 million in September, up from 1.668 million prior, and the highest since January of 2023. The layoffs rate is also what is concerning because that just skyrocketed. And as Sven Hendrick points out on X, we are now entering the hottest period of the year, at a time in which things don't look that hot. So we'll see what happens. They don't look hot in terms of bond yields that are unhinged, potential election, big tech earnings season, economic data that so far this week is underimpressing. And with so many things going on right now, we will see what the markets decide to pay attention to. And it is being reported now again that hedge funds or speculators have turned bullish on the dollar for the first time since August, and they hold $9.2 billion in long wagers on the greenback. It's actually not good at all because when the dollar goes up like it is right now, it tends to pressure equities. Okay, this period was 2022. The dollar went up about 20%. And the easiest way to think about this is use Tesla as an example. Tesla reports their earnings in US dollars. Okay, so if the dollar is going up and other currencies are pegged to the dollar, they derive their value from the dollar, they're compared to the dollar. If the dollar is going up, the rest of the world's currencies on aggregate are falling in value. That means if Tesla sells a Tesla in China, let's say, for 300,000 won, they take that 300,000 won back to US dollars at a stronger dollar rate. That 300,000 won gets less US dollars. So the higher the dollar goes, the worse off it is for companies that take in foreign currencies and convert that back to dollars. So in simpler terms, the higher the dollar goes, the more pressure it puts on stocks. And we've seen this talked about a lot in 2022, but the dollar has been relatively in a range since 2022, so it hasn't been as big of an issue. And just in case you guys missed the last video that was posted to the channel, yesterday was the single best day of any year dating back on the S&P to 1950, okay? And that's exactly what happened. Yesterday was a good day. The average return is 0.51%. The return that we ended the day with yesterday was 0.31%. Now, today the S&P is up 0.18%. The average return for today is 0.32%, dating back again to 1950. So you are underperforming a little bit over the past 2 days relative to historical standards, but really throughout this week, at least until Thursday, you tend to be in green territory. Now, once you get to November, you tend to have a little bit of a pickup, right? The first couple of days of November, and then things tend to turn a little bit more red once you get through the first week of November into the second week of November. That's where things get a little bit on the choppier side. But I think the jury is still out on whether this is going to be a good period or a bad period. I think you need to get the rest of big tech earnings out of the way. When you get those earnings, when you get closer to the election, when you get the actual election taking place on November 5th, and then we'll see if we know who the president is. If we don't, liquidity could become an issue. We're already seeing some very low activity. Like, there's not a whole lot going on in markets these days. Yesterday, you only have 30.1 million shares that traded hands on the SPY. That's one of the lowest volume days you've seen all year. Like, this is a very low volume period. So if we get more volume coming in, is it bullish? Is it bearish? Selling pressure, buying pressure? That is still very much unknown. But I will just point out what a lot of people have said is they're really waiting until after the election to reallocate to different sectors. And that looks obvious in the volume breakdowns on the S&P. You've been at below average volume for the last couple of weeks. And Seth Golden writes on X, fund flows have the third heaviest period in November, with the median S&P election return going from October 27th through December 31st of positive 6.25%. Now, oil is trading down again, another 0.5% or so, down to $67.11 per barrel, which should be having, the effect of pushing down 10-year treasury yields again alongside the weaker than expected economic data, the essentially plunging of job openings. But that's not happening again today. It seems like the bond market and the stock market live in totally different economies, which whenever you see the bond market acting irrationally, like not following common logic, it's a time in which you want to be a little defensive, because if the bond market's acting irrationally, which is much larger than the stock market on a total value basis, you have a problem. Now, is that a good problem or is that a bad problem? That's the question. You can see today the equal weight S&P is not faring nearly as well as the market cap weighted S&P. The RSP is down 0.21%, whereas the headline S&P, the market cap weighted S&P, is up 0.2%. And again, that's just because big tech is really outperforming today. Apple up 0.25%, almost at a new all-time high. Netflix at a new all-time high, up 2%. Nvidia up almost 1%, near its all-time high. Meta up 2%, near its all-time high. Google up 1.7%, the underperformer of the bunch. They do report earnings today. Microsoft, and really with Google, you want to wait till the earnings call. That's when you'll get the final move for Google. Microsoft up 1.1% and Amazon up 1.3%. Really, if it wasn't for big tech, markets would be having a rough day today. David Rosenberg points out something that I think a lot of people need to see. He writes on X, wondering why consumer confidence shot the lights out in October. Look no further than the accompanying chart. As James Carville would say, it's the stock market, stupid, and higher stock prices lead to confidence being higher. That's usually what happens. Sven Hendrick writes on X, we've reached the close your eyes and buy stage. This is a report from Unusual Whales. This says short seller Carson Block says close your eyes and buy big US stocks as per Bloomberg. The Kobisi letter on X writes, how does the S&P 500 historically perform after the presidential election? In the last 8 years, the S&P 500 rallied an average of 6.6% in the 6 months after Election Day. By comparison, 6 months prior to Election Day, the index saw an average return of 1.5%. In the last two elections, the S&P 500 posted 3.9% and 18.5% returns 6 months prior, and 12.1% and 24.4% gains 6 months after the election. Meanwhile, over the last 6 months, the S&P 500 is up 14.2%, well above the historical average. History suggests more gains are coming for stocks. I would push back on that a little bit and say that this is a very different market from prior election periods where there's so much uncertainty. There's uncertainty, obviously, with the candidates and the polar opposite views of different things, specifically in regards to the economy. So I think there's a lot of uncertainty there. I think the bond market being broken the way it is now is very unnormal. It's very much something you don't see all the time. So I think there's a lot of uncertainty there. Company earnings, market valuations, they're very expensive. They're pricing in a lot. I think that's a little bit different from other times where the leadership maybe was a little different. Today, it's in 7 stocks. They're leading markets higher at this point. Some of that has to do with the bonds being derailed. Again, the lack of leadership you're seeing in the RSP over the past 2 weeks or so, is a little concerning. At least personally to me, if we are heading into this soft landing and things are going to be fine in the economy. We've seen today, things are not fine in the economy. JOLTS job openings plummeted. The layoff rate rocketed higher. These are things the bond market totally ignored. Stocks totally ignored. It's almost like the data doesn't matter anymore. So I think to just make the comparison of prior election cycles and say that's going to happen this time with certainty is very naive. Could that happen? Yeah, sure. Anything's possible. I think longer term valuations really don't matter anymore to a certain extent. Clearly, they don't matter. Valuations do not matter. Okay, let's establish that. Valuations do not matter. I don't think stocks are going to fall based on valuations. They don't matter. Stocks wouldn't be trading where they are if valuations matter. So, that's really not the argument here. The argument is we have so much uncertainty that are you likely to just continue to go up in a straight line? My opinion, no. In my opinion, we are vastly overdue for a real correction. Was early August a correction? Technically. I predicted this correction too, by the way. And I'm predicting another correction. But in August, the correction lasted for literally 2 days. 2 whole days. 48 hours of trading, and the correction was over with. Let's try to get a correction that lasts 2 weeks, and then we'll see where sentiment evolves and where people derive fair values. Now, again, is that going to happen? I have no idea. That's why you want to be fully vested in this market with extra cash on the sidelines. I think that's the best way to play this market. Let me know your thoughts on all of this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.